It's a pleasure to be speaking at the ILS Asia 2021. I want to thank our partners at Artemis for this opportunity. My name is Shevawn Barder, and I am CEO of RE Syndicate, a reinsurance intermediary based in Dallas, Texas, that provides reinsurance capacity for primary program business. At RE, we have consistently produced profitable combined loss ratios on U.S. domestic primary specialty risk insurance. We have extensive underwriting expertise that allows us to customize a security's appetite to create a tailored risk portfolio to realize best-in-class results. I am here today to provide an overview of the U.S. specialty market, and in particular the program segment, as well as identify this opportunity for Asian reinsurers, investors, and capital providers to tap into the U.S. primary market. When you think about the insurance industry in the United States, it's important to understand the country as a whole. The U.S. is ranked number one in terms of GDP. The GDP of the United States is $20.5 trillion. The population of the United States is 328 million, and the economy is broad and diverse. Still, the population of the United States is highly homogeneous, which is relevant because it makes it very easy to sell goods and services in the U.S. market. Insurance and reinsurance products underpin the smooth running of the economy, and they adapt to provide support for changing aspects of the economy. We can see this with the advent of Insurtech and cyber insurance, as these parts of the industry have expanded to meet the needs of the consumer. The insurance industry in the United States wrote $1.32 trillion in 2019, of which life and health insurance represents $679 billion, and property casualty comprised $638 billion. Both these segments require significant reinsurance capacity. For the purpose of my talk today, I will focus on the property casualty sector. P&C insurance is broken down into two segments within the property casualty market. We have the personal line segment made up of home and auto insurance, and we have the commercial line segment, which is comprised of casualty, property, marine and energy, cyber, and specialty lines. The insurance industry in the U.S. is regulated at a state level by a body called the National Association of Insurance Commissioners, which has been in existence for 150 years. The NAIC sets standards and regulatory support mechanisms for the industry. Within the P&C sector, insurance companies are broken down into two distinct segments. We have the admitted or retail companies and the non-admitted, identified as excess and surplus lines carriers or wholesale companies. As all insurers are regulated at state level, state insurance departments approve insurance carriers. Admitted carriers must file rates and forms with the Department of Insurance in their state. There is a strict approval structure as these companies sell their products to members of the public. So there are demanding mechanisms in place to protect the consumer. State insurance commissions strictly monitor these companies in terms of premium to surplus ratios. On the other side of the spectrum, you have the wholesale market, which is the surplus lines market. The excess and surplus lines market is not bound by the same restrictions as the admitted market. This is primarily because they don't sell insurance to the public. So there's more flexibility with regards to rates, filings, terms and conditions. The excess and surplus lines market has the ability to fill the gaps that the admitted market can't provide coverage for. This market segment absorbs the business that is not written into the admitted market. As it is less regulated, it has the ability to adapt quickly to a changing market environment. There are four distinct distribution channels within the U.S. market. You have the direct sell companies, such as Geico or Progressive. You have insurance brokers, such as the large corporate brokers like Marsh McLennan or Aon, and smaller regional brokers. You have captive agents representing one individual insurance company, which are exclusive to the company. And finally, the program segment, which is made up of MGAs, program managers, fronting carriers, and is supported by third-party capital or reinsurance capacity. A little bit of background to the concept of an MGA. MGAs were initially established to represent insurance companies as a distribution mechanism with a less expensive infrastructure than, for example, creating a branch office. They have evolved out of this concept as a cost-effective way to access and sell primary insurance. MGAs and the E&S market represent $125 billion in premium income in the primary U.S. market. Now, increasingly, with the advent of capital and more sophisticated software and technology, MGAs have essentially become mini insurance companies in that they can write business, account for premiums, issue documentation, and settle claims at a very low expense ratio. A best-in-class MGA has a specialist underwriter, understands their business segment, has localized knowledge, and a vested interest in performance, a high renewal retention rate, customized product offerings, and the ability to adapt quickly to a changing market environment. This is because business is written in the wholesale or excess and surplus lines market. In addition, they have excellent geographic distribution. For example, in the United States, you can see hundreds of MGAs in the market that have created footholds in distinct geographic locations. This is very beneficial to the insurer because these MGAs have strong local understanding of their markets and requirements. This level of control over their market is an ideal scenario for partnering companies. MGAs access the market through an agent or broker, and in some circumstances, they can access the insured directly. Therefore, this is a very cost-effective and efficient structure. MGA's results can be benchmarked against the P&C industry, which they generally outperform. This is because they have a very specialized and focused business model and a very low-cost infrastructure. This makes them an effective way to access the primary U.S. market. Increasingly, it's become common for ILS fund managers to work directly with reinsurance intermediaries and MGAs. Some ILS fund managers have even developed their own MGAs. Similar to how large institutional investors, such as pension funds, work with reinsurers to access risk through structures like sidecars, they can do so in a bespoke way by partnering with a reinsurance intermediary. In fact, these relationships are proving themselves to be an innovative and flexible way to access primary sources of U.S. risk. These partnerships can be used to access a variety of U.S.-based risks, such as property catastrophe, or more predictable, low-severity, non-nat cat risks in a more efficient manner. In terms of the value chain within the program market, the process of placing business starts with the retail broker who produces the business from the insured client. The broker places the business with the MGA or program manager. The MGA has the underwriting and technical expertise to rate and assess the business. A fronting carrier provides the paper, compliance, and regulatory requirements. The business is written on a quota share basis, with the insurer or reinsurer providing the support capacity to absorb the risk. Now, what is the program market? The program market is comprised of MGAs that write primary business, fronting carriers that provide the paper and administer the regulatory function, and the supporting insurance or reinsurance capacity behind that. Examples of business classes within the program space include transportation, cyber, flood, liability, habitational property, and marine classes are all written on a program basis. The structure is a highly efficient way for international reinsurers to access the distribution of primary specialty business in the U.S. market. Program business requires a special skill set. It is written on a quota share basis, is highly detailed, and requires a technical underwriting approach further supported by in-depth analytics. All program business is written on a quota share model, which means all participants' interests are aligned for a profitable outcome. It is primary U.S. grassroots business written by expert underwriters with focused distribution networks. It's low limit, low severity, minimal nat cat exposure, and well geographically spread. Premiums are collected by the MGA, and claims are handled as an offset. Monthly reporting structures are tight and can be kept to a 45-day timeline, so results are reported in real time and can be tracked to monitor performance. Control mechanisms are very tight due to the real-time monitoring process already described. Monthly expectations of results can be budgeted and checked according to performance. This is a unique characteristic of the program market, as traditional quota share contracts report on a quarterly basis. Interestingly, MGAs that participate in the excess and surplus lines market have experienced less disruption during COVID than composite insurance companies. This is primarily due to the fact that these are smaller operational units in a less regulated environment. During COVID, MGAs have been able to quickly react to market-changing conditions and adapt their terms and conditions accordingly. In this way, they can supply the product that is needed, as they are not required to refile rates and do regulatory paperwork. They can react quickly and nimbly to the market condition and meet the requirements of their customer. Fronting carriers provide the paper and regulatory framework for MGAs to write the business on. This is a critical function, as they comply with all the regulatory and filing requirements that are necessary for the MGA to write business. And in this way, MGAs are not distracted by that burden. The MGA instead can focus on the business that they need to write. An example of a long-standing fronting carrier in the United States is State National. State National has been around for many years and is recognized as one of the original fronting carriers. State National has a long history of working with ILS funds or investors to provide the paper necessary to front access to insurance business. Now, taking a macro perspective for the insurance company or reinsurance company participating in program business, the reinsurer participates at $1 to achieve the best primary rate in terms of the exposure written. Primary U.S. business is inherently stable, well spread, and can be structured to avoid nat cat and aggregation. This type of portfolio is a natural hedge against a nat cat portfolio of property risk, for example. Limits are controlled to avoid volatility and exposure, and due to the spread of risk, create a stable premium volume with consistent cash flow in terms of balanced settlements. The current market is such that reinsurers can influence guidelines, pricing, claims management, and through this process, international reinsurers can access diverse classes of primary business. Significant volume can be written in these classes with extremely low limits. We see the market continuing to evolve as insurance and reinsurance capital is increasingly fluid, which will naturally benefit ILS funds and institutional investors. ILS funds and investors partnering with reinsurance intermediaries can work to build programs tailored to their desired risk and return profiles. For example, if an investment vehicle was developed with RE, there would be an opportunity to add more attritional, low-limit primary market risks to a portfolio. This approach could lead to investors securing a tailored risk-return profile. At AmRe, we focus on primary program business, which provides a predictable return profile, which is more stable due to its consistency. Partners can select specific risk class pools, including defined risk parameters, meaning they have a well-defined portfolio of what's going into the vehicle when signing up. In a period of very low interest rates, ILS sidecars might expand their focus to these less volatile business lines. We believe this change should create an uptick in investor interest. For many pension funds, for example, the ability to earn consistent, high-quality returns for attritional, low-severity, low-limit business, the type that AmRe writes, would be very attractive. Relative to rates in Asia, the U.S. rate environment has accelerated significantly over the past 12 months. In addition to the hardening rates, there is also now a lack of capacity within certain business lines. This lack of capacity has created genuine opportunities in the primary market. So currently, there is a hard market cycle. Pressure on rates at a primary level have created a robust underwriting environment for the first time in many years. If we look at rates in the property and casualty space across the spectrum, all rates have increased significantly. Even if we look at the average rate, we see it has increased by 11.6%. So there are strong increases across all main classes of business in the primary U.S. market. Through partnering with AmRe, for example, international insurance companies can take advantage of the opportunities available in the market. AmRe's management has been in this segment for over 20 years. We are well known and respected. We partner with international reinsurers who have a desire to write high-quality niche program business in the primary U.S. market. And we customize each program according to their specific needs. We align ourselves with expert MGAs, and we have significant traction in the U.S. primary market. We focus on long-standing, stable, and mutually beneficial partnerships to create an environment with sustained and consistent growth, which is solidly profitable. We have outstanding distribution through our platform, a high level of expertise, and the ability to focus on the technical terms of underwriting. At AmRe, our underwriters are former primary underwriters, which makes them experts in their class of business. We have a specially trained team of analysts who manage the quota share reporting. And finally, we have proprietary software programs and a database that can be used to benchmark performance and is available to our partnering securities. Historically, we've worked exclusively with reinsurers, but we welcome the opportunity to discuss how we can develop additional relationships with ILS funds and institutional investors to create mutually beneficial, value-added partnerships through trusted platforms and expert teams. I would like to encourage reinsurers and ILS or institutional investors to take a closer look at AmRe and discover how they might add some of the risks discussed here today to their portfolio, and how doing so could assist them in diversifying their portfolio and achieving their desired risk and return profile.
Shevawn, thank you for your insightful keynote speech. I really do appreciate that. I thought it gave a really good overview of the AmRe business model and why it's an appealing one for those with capital looking to access returns from the reinsurance market. Now, the reinsurance MGA model is one that isn't so familiar in the Asian marketplace, and it's one that seems to hold quite a lot of promise, both for reinsurers and also for the ILS investors in the region, and that's a lot of our viewers, hopefully today. So as the insurance-linked securities market continues to expand, ILS funds and investors are increasingly looking for new ways to access risk. They're looking for partnerships. They're looking for diversifying opportunities. And the AmRe business model seems to offer those in abundance. And in being an aligned partnership-based approach while offering access to a class of business that's a little different for the ILS market as well. So I thought we could zero in on the ILS investor opportunity to access underwriting returns through a partnership with someone like yourselves. Now, to me, it seems really important that alignment of interests are strong for an ILS investor and funds, and it's something that they really do focus on when they're trying to engage with another entity. And origination capability is another key trait that makes these relationships attractive to the ILS market as well. So perhaps you could talk a little bit about how AmRe generates its underwriting opportunities to begin.
Thank you. Thank you, Steve. And it's great to be talking. In terms of where we find our underwriting opportunities, it's organic in that we have created our model and our platform, which are unique and distinct. AmRe is a very well recognized brand in the market, so opportunities come to us. Many market participants understand the value and sustainability that we add to their business. This is great for AmRe as it allows us to choose the highest quality MGAs to work with. We have a clear, well-defined risk appetite with specialty lines, and we have the expertise to look at a broad selection of programs. We have chosen MGAs who perform well. With the addition of our expertise, their performance is enhanced and the results usually improve. Rates in the US market are at all-time highs, and this is reflected in our portfolio results. So all our business is written on a quota share model, and as a result, all parties' interests are aligned to create a profitable outcome.
Great, and there's a couple of things you mentioned there that I think will be really interesting for the ILS investors listening to this. There's the fact that AmRe's expertise on top of the MGA can almost enhance the results of portfolios. That's very interesting. And then obviously the rate environment as well and the opportunity at this point in time. Now, the risks that you might be able to offer to help investors get access to them, they're a little different from the peak catastrophe exposures that we see in the ILS market through catastrophe bonds and the like. So it's a more attritional nature of the specialty business. It's going to be something that's a bit new to some people. So perhaps you could explain why this type of lower severity, more attritional risk could be attractive, and also how AmRe can help to add an element of predictability there to help investors with their portfolios.
Absolutely. So our portfolio would create a hedge to the Nat Cat severity risks inherent in an ILS portfolio. And what it comes down to really is frequency versus severity and risk selection. Our model is attritional, but with the strength of rates in the market, attritional business should be attractive to an ILS market because, again, what we're proposing is a hedge against that Nat Cat exposure. We write very low severity risk, which is non-Nat Cat, grassroots, and very well spread. We write to an average limit of $750,000 to $1 million. And this business is really U.S. domestic centric business. It does not travel into the international market. And we have the ability to tap into these business sources. So we focus on program business because there's predictability inherent within that model. And we have been in the segment for over 20 years. We have a high level of underwriting expertise to ensure we make really quality risk selection decisions.
Yeah, that's really interesting. And you mentioned sort of the smaller ticket size of the lines that you put out, which obviously I assume equates to a very diversified portfolio as well, which is quite attractive. But I mean, AmRe has its specialisms and its expertise, but might you be prepared to expand your underwriting appetite with the help of investors and partners if the right capital providers come along?
Yes, we would be very happy to expand our underwriting model with the right capital partners. If investors or reinsurers have a particular appetite, our platform gives us the ability to access a broad spectrum of risk classes. So due to our traction within the market, we have a very broad selection of quality program business, and at the moment we lack the capacity to write some of those classes. We have a very high level of underwriting expertise, and as a result, we can tailor a security or an investment fund's appetite to meet with the classes of risk they would select. Our in-house analytics mean we closely monitor our program business in real time so that performance can be monitored and tracked to meet expectations. Any deviation we can tackle quickly and effectively. We can also critique terms and conditions to meet a particular appetite and work to our advantage.
Yeah, that's also very interesting to the investors watching. I would imagine that you can work with cedents to help improve the performance of the business, and I assume that improvement works both ways as well in the coverage they get too. And you also mentioned there that about the tailoring of portfolios. That's something that I think would be very attractive to capital providers at this point in the cycle too. Now, in your speech, you said that you typically partner on a quota share basis with your capacity providers, but I know Amri's been exploring plans and working on establishing an underwriting balance sheet lately as well. Is this something that you'd see there being a role for an ILS investor to assist with too?
So absolutely. Currently, we are going through the process of authorizing an excess and surplus lines carrier in the US market. And yes, of course, we would love to partner with an ILS investor. For example, we could replicate the concept of a sidecar with program business that we currently write. And due to the current trading environment, we see excellent trading conditions that manifest into solid combined loss ratios. And with quota share, it results in a steady balance of payments. So we can create a steady income stream on specific business classes with real longevity and sustainability as we partner with the right MGAs.
That sounds like quite a symbiotic way of doing business as well, with your capital partners and yourselves both benefiting from this expansion that you could have. Do you have any specific thoughts around the type of structures or mechanisms that investors could work with Amri on?
Well, our expertise is in program business, so we can select and write the risks and manage the portfolio. We would look to our partners to assist us with the creation of an investment vehicle. We're flexible because we are open to different forms of partnerships, whether they're in a traditional sidecar approach, an ILS pool, or another form of investment. From our side, we can create tailored risk pools and structure them in a very clear way to match an investor's appetite. Thus far, we found that with our track record, our ability to tailor programs, track performance in real time, and benchmark data to identify and set accurate expectations, that has been very attractive to reinsurers. There's no reason that that concept could not be rolled out to a different cross-section of investors. And as far as an investment opportunity goes, the timing is now really in terms of the market cycle. Rates are at all-time highs, and there's tremendous opportunities in the primary US market due to lack of capacity in certain classes. So, this is a combination of circumstances that have come together, and we feel it's very opportune.
No, it does sound so. And again, you mentioned another thing there that sounds quite interesting from the investor point of view, and that's around the data and the way the cash flows work within this type of business too. I think that could be a very attractive thing, because there's a lot of transparency there for anybody who's providing capacity behind these sorts of structures. So with the opportunity right now being particularly attractive, as you just said, the hard market environment continues. Why should investors and ILS funds look to somebody like Amri for a long-term partnership?
So, there's incredible sustainability in our business model due to the fact that program business is written on a quota share basis. Quota share contracts are a long-term and stable form of reinsurance. Once a quota share is set up, it's structured to fit specific requirements. With the lack of severity in this model, it lends itself to more stable and sustainable outcome. With quota share, all parties' interests are aligned to create a profitable outcome. The demand from ceding companies is extremely high. This high level of demand contributes to the ongoing sustainability of the model. So a quota share contract lends itself to the same kind of concept as structured income. Balances are settled on a regular monthly basis, and we can tailor the risk pool according to appetite.
Still, in general, we see the business as pure risk reward with less volatility and more sustainability over the long term.
And that really should be music to the ears of any investors or capital providers watching. What they are looking for is opportunities. There's a strong alignment, but there's also a clear chance to source decent quality risk. And it does sound like that's something that your business model could help people to gain access to. So, Shevawn, I'd like to thank you for your time. I'd like to thank you for the insightful speech you gave us earlier, and also for your support from AmRe for this event as well. I really appreciate you taking the time to talk with me and dive deeper into this subject today.
It's been a pleasure, Steve.